October 16, 2009, 6 a.m., Sutton Place, Manhattan. Inside a penthouse worth more than most Americans will earn in 3 lifetimes, a 52-year-old billionaire is asleep. He does not know that 11 floors below, 6 FBI agents are quietly checking their weapons. That billionaire is Raj Rajaratnam. Wall Street called him a genius. He took the Galleon Group, a hedge fund he built from nothing, and turned it into a $7 billion empire. In high finance, extreme wealth is justified by one skill: consistently predicting the market. If you beat the street year after year, investors reward you. They rarely ask how you do it, because from the outside, deep insight and illegal cheating look identical. In 11 minutes, those agents are going to knock on Rajaratnam's door to prove his celebrated market foresight was actually just time travel. By every outward measure, Rajaratnam seemed to have earned his billion-dollar net worth the hard way. He made aggressive bets and invested in technology years before the crowd caught on. But a closer look at his trades revealed an impossible pattern. His stock picks moved just hours before corporate earnings were released or major acquisitions were announced, perfectly avoiding sudden losses and capturing massive, immediate profits. Catching a crime like this is difficult because it is almost entirely invisible. By trading on advanced knowledge of numbers from companies like Google and Intel, Rajaratnam generated over $60 million in illegal profits and avoided losses. To dismantle a fraud of this scale, federal prosecutors had to tear down Wall Street's most closely guarded illusion: the idea that everyone is playing on a level field. Insider trading works on a very simple mechanism. Someone inside a company knows a valuable secret, like an upcoming merger or a surprise loss. If they share that unpriced data with an outsider, that outsider gains an unearned market advantage no amount of research could replicate. Rajaratnam knew the risks, so he built a protective layer. He rarely spoke to the primary corporate sources himself. Instead, he laundered those secrets through an elite network of middlemen, business school friends, and industry consultants. His lawyers later called his strategy the mosaic defense. They argued he would simply collect small fragments of public information and synthesize them into a legitimate trading thesis. In reality, prosecutors argued, it was a mosaic defense in reverse, a system explicitly designed to make stolen tips look like legal analysis. This network structure deliberately severs the direct link between the origin of the secret and the final executed trade. If regulators ever asked where a tip came from, the trail would run cold 2 or 3 names before it reached Galleon Group. Knowing paper trails were useless against this setup, the Department of Justice deployed Title III wiretaps. They took the exact same legal surveillance tools built to catch mob bosses and drug cartels and turned them against a Wall Street hedge fund for the first time. When an illicit system produces no paper evidence, the only way to beat it is to listen to the criminals operating it in real time. The government captured 9 months of Rajaratnam's phone calls, which led them straight to his informants. These were not desperate people. Anil Kumar, for example, was a senior partner at McKinsey, making well over $500,000 a year through legitimate, highly respected work. Yet Kumar accepted secret payments from Rajaratnam. The money was funneled through a fake consulting arrangement, sometimes routed through a bank account in his housekeeper's name in India. Behavioral economists point to a specific psychological trap that explains why someone with so much to lose would risk it all. Proximity breeds permission. When you spend every day advising clients making 10 times your salary using the exact same information you already hold, the line between insight and theft blurs. Sharing a tip stops feeling like a felony and starts feeling like a professional bonus you were never offered. Elite Wall Street culture drove this betrayal, one where trading stolen secrets signaled that you finally belonged to the inner circle. That culture finally faced a reckoning. During the 2011 trial, the audio wiretaps proved insurmountable. After less than 2 weeks of deliberation, a jury found Raj Rajaratnam guilty on all 14 counts of conspiracy and securities fraud. He was sentenced to 11 years in federal prison and ordered to forfeit over $60 million. His $7 billion empire at Galleon Group collapsed, its offices emptied, and its investors' money returned. The destruction extended far beyond Galleon. Highly respected mentors saw their reputations evaporate. Rajat Gupta, A Goldman Sachs board member and former mentor to Rajaratnam was convicted in a related case and sent to prison. Rajaratnam's conviction led to a series of criminal charges against more than 60 people across nearly every major institution on Wall Street. The government established a new standard for what constitutes a market edge, proving that if a market advantage comes from a stolen secret, it is a felony, regardless of the trader's pedigree or wealth. This struggle to police the gray zone between deep insight and inside information is a recurring theme in financial history. From Ivan Boisky in the 1980s to the rise of expert network firms, Wall Street has continually tested where the rules apply. The stakes of this cat-and-mouse game affect everyone. Every time you invest a portion of your savings, you are operating on a baseline trust that the market rules apply to everyone equally. Rajaratnam's case proved that at the highest levels of global finance, a handful of people are playing by a separate, hidden set of rules. And in a system built on secrecy, your only real defense is knowing that someone, somewhere, is listening.